Hi everyone, this is Robert Eldridge with annuitycampus.com. This video is about 401k rollovers. If you spent your whole working life or you left a job that has a 401k, what are you going to do with it? You got to roll it to an IRA, which most people understand, but they don't know what kind of instrument to roll it into. You can have an IRA in mutual funds, you can have an IRA in stock accounts, you can have an IRA in annuities. And as long as it's qualified, it's pretty easy. So here's what I recommend. If you don't want any more of the market losses, but you want some more interest than a general CD, look at an index annuity. And here's the reason why. Index annuities have a minimum guarantee, so no matter what happens, you have a minimum guarantee. Also, they're tied to an indexed, like an S&P 500, with a cap. So what that means to you is this. You get to participate in some of the market gains, but absolutely zero of the market losses. So if there's an S&P cap of 10% and the S&P does 5, you get 5% added to your account value, alright? The next year, if the cap is 7%, let's say, and the market does 10, you get 7. Oh, and by the way, the insurance company doesn't keep the extra 3%. They're just buying the option up to the first declared cap, which in this case would be 7%. So I just want to make sure. They don't keep a spread, by the way. So let's say now the market goes down. Oh my God, I lost money. All hell broke loose in the market. Nope. Not only did you keep your principal, but you've kept all the gains you've made in the previous years. You see, with the index annuity, you either go up or you stay on the same step. When you stay on the same step, what does that mean to you? That means the market went down and you got a 0 on your statement. So let me ask you this. Would you rather have a 0 on your statement or a negative number? Because if you have a negative number, you have to make 100% back to get back to where you were. With an index annuity, you just stay right there. So if you have $110,000 cash value, market goes down, you keep $110,000. If the market goes sideways again the next year, you still have your $110,000. If the market goes up 10% and you got 7% of that, that goes to your cash value. So annuities were specifically designed hundreds and hundreds of years ago with retirement in mind. That's what I'm getting at. If you have a 401k, what is that? It's a retirement vehicle that the government allows workers in the United States to put money in. It'll grow tax deferred, and when they need it, the government's going to tax you on a percentage of that. So with an annuity, it works the same way, whether it's qualified or non-qualified annuity. 59.5, if you take money out, you'll get assessed a 10% IRS penalty. See, there's a lot of features to an annuity, especially index annuities. They guarantee you an income you can't outlive, okay? Every single annuity out there offers this. It's the only instrument that will allow you to take money for the rest of your life without outliving your money. You avoid probate, so if you don't use the money or all of it, the rest of the money goes directly to your beneficiaries, just like a life insurance policy does. Tax deferred growth. Well, we talked about that. Annuities do the same thing. If you don't need the money, or all of it, it'll continue to grow without you incurring a tax bill every year and pay taxes on money that you don't need. If you need money from your 401k after you've left a job and you're over 59.5, you can buy an immediate annuity, by the way, and that'll generate the income. Protect principal, we talked about that. With index annuities and fixed annuities, there's no charges for protecting your principal. Liquidity. Now, if you need money, let's say a couple years down the road after retirement, or you've reached that age, you can take out interest only, 10% withdrawals. You can annuitize the contract, which is a fancy word for saying payments for life. You can have return of premium riders. There's all different ways that you can access that money, and I can show you that. It just depends on what annuity works best for your situation. Asset protection. This is a big one. Let's say you've worked your whole life for this money and you don't really need to tap into it, but again, you like knowing that you can, so they're liquid. However, let's say there's a lawsuit. Let's say you have a car accident or something. Well, depending on the state that you live in, each state has a protection, a creditor protection for annuities. And what that means to you is you need to check with your state. It could be up to a certain dollar amount. So in other words, if there's 500,000 in there, creditors can't touch the first 500. I think states like Florida and Arizona, it's unlimited. Certain states like Nevada, they only cover the income stream of the annuity, not the actual principal amount. So it just depends on where you live, but they make great asset protection tools. And what annuities really are they diversify your overall portfolio. So if you have any questions on annuities when it comes to 401k rollovers, you should really take the time to look at these and see if you want to roll some or all of that money into an annuity or various annuities. Why not ladder it? Give my office a call. I'd love to give you a consultation and see if we can work together. Again, thank you very much for your time today, and have a wonderful day. Bye-bye.